We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the CashFlowPro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of CashFlowPro, your daily real estate investing podcast and YouTube channel. I'm here today with Bruce Wuollet of Bakerson. He said right before the episode, and I know my listeners will find this right comical, he is a SOB. He is the son of a baker. So there we go, Bruce. You got it, man. There's the introduction. I hope I hit that right.
That's great. Yeah, that's good. Yeah. I grew up in the bakery business, so paid homage to my father. And I'm a baker's son, a son of a baker.
Son of a baker. I think we all like to look for terms, reasons to call people SOBs anyway, right?
That's right.
Anyway,
so when people call me an SOB, I tell them thank you.
Thank you. I appreciate that. Well, good deal, man. Well, tell us a little bit about yourself. I know we were talking. You're kind of in that Phoenix market, and you know we have some general our friends kind of overlap there. It seems like because that market really has been booming, and my listeners probably get tired of me talking about how this is how I envisioned Phoenix was founded. There was two guys riding on a horse. Leaving California. They were leaving the gold rush or something maybe. And they stopped like in the middle of the desert and they looked out and they saw those hills, right? About however far away. And they were like, damn, this looks like a good place for a city. Let's start a city right here. I have no idea. I've traveled Phoenix front to back, left to right, side to side. And I really, for the life of me, I know it kind of bred from Scottsdale, but I can't for the life of me figure out what the draw to that valley was. But nevertheless.
Well, part of it's the converging of two rivers. We got the Agua Fria coming from the northwest, and we got the Salt River coming from the northeast, and they converge there, so there was water. But and actually, I haven't invested. It's been a number of years. I have not invested in the Phoenix market. We're in Arizona. We do Tucson, Southern Arizona, but we've expanded outside because we're buying cash flow, and I'd like to talk a little about that at some point. But yeah, Phoenix market is pretty sick, and it's pretty fun to watch. But it's I haven't been involved too much because there's no cash flow deals right now.
Well, and that's what like I told you before. Some of my friends that are out there in that market, I'm just astounded that they're able to make things work. I mean, and some of them, because the first lesson that I learned in this business was you always buy for cash flow. Everything else is nominal. Everything else is to some degree icing on the cake. And again, you're forcing some appreciation through rent growth, right? But at the same time, when you're looking at some of that stuff, it's like, damn, how much growth could there possibly be left here? Or
to me that it's not the icing on the cake is what you want, and the sometimes you get a scoop of ice cream on top of that, and that's the equity gain. In the last 4 or 5 years have been pretty insane in Phoenix as far as the equity gains. Makes me a little bit nervous, and I don't like to sell. I really don't enjoy the sale process. I love the buy process. I'm really excited when we buy, and when we sell, it's anticlimactic, and it feels like kind of like poof, let the air out of the balloon. So we're not selling anymore. We're not sellers. Nothing we have is for sale, and I don't see it for sale in the foreseeable future. And it's one of the secrets I wanted to share is the fastest way to shrink your database of investors is to go from buy, fix, and sell to buy, fix, and hold. And then it's like crickets. And I laugh. I say crickets don't have money. So, but yeah, that we shrunk our database of investors way down. We said we're going to buy and hold indefinitely, and they didn't like that because in short term, there's a lot of money being made right now, especially everywhere in the country, but especially in Arizona. And so then the question I like to ask the investors is, why do you consistently put the sponsor out of work? Because anytime we sell a property, guess what? we got to go look for another one. You get your money back. You got your whatever, however the investors have made their money, they got their money back. They're reinvesting in something or having it sit in the bank. But that's my livelihood. And now I got to go find another one and another one. And it's exciting until the train stops. And we've seen some big changes now with the increased interest rates, and we're going to see some more changes in the next 1 to 3 years. I think people that we're planning to exit in 2023, 2024 are going to be in for some surprises with the increased cost of money overtaking the increase in demand, and you won't see the price increase that they projected.
And and I've always figured that I'm really trying to figure out a way to phrase this, but I'm always hesitant to look at a deal. Like, so if a syndicator comes to me and they're like, "Hey, here's the deal. This is what we're going to do. This is our plan," right? And I understand the rent growth part of it. It makes sense, right? You're going to increase the rent, you increase the income, you increase the value. That makes sense. But the problem that I run into, or the problem that I have a hard time getting my mind around, or at least telling investors when they come to us, is the value add portion. And that's, again, I know I'm talking different than what you're saying. I get that. But I guess what I'm doing is I'm giving some justification to why doing it your way is actually beneficial. But do you have, like, I could see your way being beneficial if you had like a 90-day clause where somebody called and said, "Hey, Bruce, I need my money back." And you're like, "All right, cool. 90 days, we'll have it back to you." But if you're just like, "Hey, I need your 100 grand and it's here forever," I do see that being a tough nut to crack. But the value add proposition in this whole market is what I think I have the biggest problem with, because then you start talking about pro forma numbers and how much that value add is going to add to the rent rather than just rent growth. Does that make sense?
It does. And one of the things that that you learn when investors work with us, they do get their money back. And this is the beauty behind our model, is we do value add, but instead of selling it, we refinance it. Why shouldn't we be the buyer? When I make a property that's 95% occupied, it's sizzling, it's running at peak performance, why sell it at that point? That seems silly. Why don't I reap the benefits of what we built there, or we as a team? And so in 3 to 5 years, refinance, investors get their capital back. But guess what? We keep the investor in the deal. So now they have zero money in the deal in about 5 years, and they still get cash flow. There's happy mail checks month after month, quarter after quarter. So the ambition with us is to sell to ourselves in essence, without through a
Sure,
refinance.
or sell it to the bank. Yeah, I get that 100%. And I've often thought that a lot of times the bank ends up with property that we all have put our sweat and tears into. They end up with it, and they're like, "We're only going to loan 80%." It's like 80%. Yeah, come on, that's good with us. We can get 100% of ours back and use 100% of yours at 80%, whatever you want to call it. So it
yeah, really, we do that, and we try to underwrite at 75%, 70 to 75% takeout. I think the 80% money, unless you get certain bridge products, those are going to go away in this cycle of of where we're at. I don't see those sticking around, at least for the next few years. It'll be more dicey. So if you buy them cheap enough, but for us to buy them it's a lot of hard work. It's very difficult. Yeah, you're exactly. To find those deals that when we buy them, they're not necessarily cash flowing on that day, but within 12 months they will be cash flowing. And then once the cash flow is in, then we can go for a refinance. And then in year 3 to 5, you go for a supplemental loan, take out the investors, and at least they can get some or all of their money back in years 3, 4, and 5, and still be in the deal. And to us, that's magic, that they're in the deal with 0%, and all of a sudden their return becomes exponential at that point, right?
Yeah. Now, does your pref payment change in terms of percentage when you refinance, return the capital? Obviously, then you have to divvy what comes in up based on expenses and payment, and and management and so on and so on. And then, of course, the pro rata of what's left, I get that. But is there, once you return the capital, does the pref payment go away and then it just becomes a pro rata share of what's left after everything's paid, after everything's paid?
Well, in effect, that's not by design, but it does happen because we end up having it's an investor 80-20 split until the investor gets their or gets 15% IRR. Once their return is 15%, then it's 50-50 thereafter. So we make it really investor heavy in the beginning to accelerate them to 15%, and then beyond the 15%, everything's 50-50. So once they get their capital back, it's infinite IRR, so it's a 50-50 split there and after, correct? But that's
Okay, so
that's for us because we have less fees at that point.
You're saying you take, like, let's say you have $100,000 income and you have 60 that goes out in mortgage payments, you have 20 in expenses together, and you have 20,000 left, right? Then investors get 10 on a pro rata share of what they have invested, and then you get 10.
Yeah, that's after they receive 15% IRR on the project. So that's project. So there's the first couple of years they may not get 15%, right? But it's throughout the life. So they'll be accelerated until they receive their 15%, and they never go below that 15% during the 50-50 split.
And then once they get that 15%, I got a little tongue tangled there. Once they get that 15% IRR, and it goes to, because the IRR is the life, is figured on the life of like the initial stages of the project, right? So once they get that 15% IRR, then if you hold that thing for another 50 years, right, everything's 50-50 as long as you own it, right?
Well, as long as there's 15% IRR. So if we go, yeah, so because they get their money back, you have to see the model. But yeah, that's in essence that's.
Well, correct. I guess I'm just curious how long. So the 15% IRR is reset annually.
Well, it's through the life of the project. So if year one we get 5, they get that's still collectible. Like they didn't lose that. Okay, now you didn't make any money. IRR, internal rate of return, isn't for 1 year. That's annualized return. IRR is the life of ownership.
Yeah. I get that. I guess I'm just saying, if you own it for 50 years, is that you're figuring that over how long?
Whole time.
The whole time.
The whole time of ownership. The IRR is internal rate of return. We can't change the definition
because it could come back below. It could come back below 15%, couldn't it? I guess that's. I'm trying to.
Theoretically, yes.
And then if it did, then the split would change at that point.
Back to 80-20, correct.
Gotcha. Okay. All right. So that's what I had some questions about that, and I had some questions about that the other day with a guy, because those hurdles are good. And I think a lot of people look at, like, for instance, when we set our deals up, we look at the hurdle from the front end. Like, hey, once we get there, our project has a definite end date. So we figure that based on, do you follow what I'm saying? So we look at it from this side of it. And when you're looking at it from the other side of the hurdle, as it being like almost a trailing number, right? Then if you fall below it, then then you're losing money.
Yeah, that's the incentive for us as operators. That's our bread and butter. It's performance based. It's success. Sure. It's like a success fee. Some people have success fees where the sponsor gets certain returns once they hit certain metrics, and we just do it as part of the profits, as opposed to fee based. So we have the standard acquisition fee, project management fee, annual asset management fee, but once the project is complete, and the project work is done, and now we're performing at 95% occupied, and the property's sizzling along, our fee-based, our income is from then cash flow. And that's why we're hypersensitive to get the cash flow. And I know some sponsors will buy out the investors at that point and say, hey, here's your return on a set return. They have a buyout program. And then they own the property without investors. And that's a great model too. That's just not our business model.
Sure.
I want to reward those that help us get there. And I've been called foolish on that, but we'll see in the long term if it's foolish or not, I guess, as it goes on.
But listen, once the thing is, and this is my thoughts, and again, like you said, it's probably, honestly, it's probably more along the lines of 50-50, 50% that do short term in the project, buy out investors, sell asset, whatever. And there's probably 50% of that hold and leave investors in. I've talked to tons of people that leave the investors in because they have the same attitude you're talking about. Hey, they helped us get here. Let's continue to help them. Let's build. Now, I think my thoughts are that when an investor is obviously going to say, "Hey, I'm continuing to get cash flow on this deal years after I got my money back, I'm going to reinvest with him again. He's got another deal. He's got another deal. This deal's doing good. He's got another deal." And that's so I feel like it gives you the reason to do that, but you're saying that your investor pool is drying up when you're saying, "Hey, these deals don't end."
Yeah, well, we ran them on a 10-year plan just as a 10-year exit because you have to put something in there to create the IR and create that. So we do a 10-year model, but we let them know that it may be 7 years, it may be 37, depending on what the market is and what else is going on in the marketplace and what other drivers there are. But the individual investors, it is regrowing. We're starting to organically get more of those. But where we're finding some success is fund to fund type of investors, people that do capital raising and they don't own assets themselves. They invest in other people's products. And that's where we're finding those. Where those people are really approaching people that are used to investing in Wall Street, where you put the money in, you wait till you're 59 and a half to get it out. You might not take it out then. So it could be, an IRA, could be 401ks, could be stock portfolios and real estate fund portfolios. So we're having a lot of conversations with the funds that need to place capital. And so that's what we're really excited about. So our goal is to always have at least 10% of the equity that's raised either by us, our money, or our syndicated capital. So we're creating multiple tranches, if you will. It's pretty exciting.
Sure. Yeah. I like the model. I think the model is great, and we're a fund of funds. That's what we do. Well, let me back up. We have a fund of funds. We also raise for some individual deals where we some investments around it. Like if we have a specific deal that we want to bring capital to, and say, hey, this is a really good deal. This is a really good buy. We need to go after this. Then man, it's game on. There's also the opportunity that we give where we can be in the investor relations business, where we can put our capital with some very well known vetted operators that we work with, and then do it that way. Then you're almost you're separating both. You know what I'm saying? Now I'm in the investor relations business. You're in the asset operations business, and we work together, right?
Yeah, we have that in our project we bought in Fort Worth. We have capital partners that came in. They brought most of the money. We're running the operations 100%, and then we have periodic calls. We closed on that 2 months ago, and it's a fun way to do business. That they manage the investors, we manage the project, and so we're going to try to scale that now with them and with others. It's pretty exciting.
I understand, man. That's great. So let's talk a little bit about current projects. What do you kind of have going on right now? What are you all looking at? Now, you said you were not in the Phoenix market, like as far as investment go. But what about the where are you at, and what are your current projects looking like?
Yeah, in the multifamily, we did 6 projects in Phoenix, and then we did 11 in Tucson, and then currently we have one in Sierra Vista. It was a Quality Inn motel, and it's going to be a 65 unit apartment building, and that'll be completed here in the next month or so.
So you did a conversion.
Yeah, because we bought it at $38 a square foot, so it was like, how could you not?
Man, I haven't had anybody talk about on this show a successful conversion. We've talked about some guys that were doing them, and we've talked to some guys, but I just in my mind, which is not all that great at times, don't believe we've had anybody that has done a full on successful conversion. So obviously, and there's a ton of different elements there, and I've heard everything from zoning issues all the way through to man, what was it? It was there's a difference in exterior walls and there's a difference in interior
Yeah,
wall. I mean,
yeah, oh yeah, fire. You have to meet the fire code, and these ones are all the walls and floors. The floors, walls, and the roof are all concrete. So that was, we knew that going in, so that helped us as far as the fire barriers between units. All the windows needed to get replaced because they're not. The lower ones have sliding doors, so you can use those for ingress egress. The upper ones did not, so we had to replace all those so you could open them up. It's a 2-story building, and then so that was one thing we knew we had to do. The three biggest costs: the exterior windows, all those that needed to go in. Then there was
that's
the fire
right.
safety sprinkler system we had to do. Sprinkler system was terribly expensive, but we knew that going in. And then new electrical, because it wasn't enough power to the units to power the units plus kitchens. So because they were studio motel, well, it was 100 units when we bought it, and now it'll be 65 when we're done. So we've combined units so that we have 2 bedrooms, 1 bedrooms, and then 1 3-bedroom, and it's really exciting. We're not complete yet. The first phase is done, and it looks tremendous. It looks really, really good. But the biggest issue you have is working with cities and fire departments, fire marshals. It's a little bit of a moving target. You think you have everything in place, you think you have everything, and there's something that's not understood. Where we thought we could have partial occupancy, and they said, "Oh, you can, but you have to have the sprinkler system has to be completely done in the whole building." And we thought, well, we have this section, we could barrier it off through construction. They looked at it and they said, no, they denied that. Well, in the beginning, they said, once phase 1 is done, you can absolutely be occupied, but we didn't know that we had to have the sprinkler system done. In the meantime, the fire marshal that was on, he retired, so we got a new fire marshal. Still a great guy, but he took somebody else's vision and he's applying it to this project, and we're running into some things that we understood differently. But the good news is it's all going to work out.
Yeah. Yeah. Well, that's good.
So that's one project. And then my son and I took down a project in Albuquerque. It's a small one we kind of did on our own. We brought in a couple of investors in the beginning, and people were like, well, I don't know about Albuquerque. You guys have been in Arizona. So we said, fine, we'll just do it ourselves. And so it's a small building, 36 units, doing a complete reno on that. And then the one in Texas is 152 units, closed on that in May. And that one's really exciting because the rents are low. It's the only multifamily in that submarket right now.
Where
right next door,
what market? What market is
Fort
that?
Worth, Texas. It's in the city of Fort Worth, and right next door is 62 plus, age limited complex, 174 units going up, and it's being built as we speak. So that should be done in September of 2023. So it's going to bring a whole new demographic to this area. We're pretty excited about that one. That's a long-term hold for sure.
Man, that's awesome.
And then otherwise, we've got offers right now on probably 6 or 7 projects between Albuquerque and Dallas-Fort Worth. And so far, people are holding firm, but they're not moving very fast. So we're not too disappointed because a couple of times they did sell and they got outbid, but we're willing to wait to get our number right now. And it's tempting to up the number just to get a deal, but I'm like, I'd rather we have numbers. If we have to meet our numbers. It comes down to numbers. If they don't cash flow based on the current rent model, I can't do it.
I just think that especially if you're looking at if we're talking about recurring investors, I mean, the last thing that you need to do is risk. You don't want to risk your money, much less risk investors' money on a deal just because. I mean, I don't know. I think you're right. We have to be so careful right now because everything is just, it's kind of like, yeah, you're tempted to just say, all right, we'll just do this one. Let's just do this one so we can get some stuff moving. All right. Well, then you get that one done and then you're like, okay, well, let's just, so you just, yeah, I mean, it's definitely
things to watch, Casey, that people, there's 2 things that I haven't seen in underwriting that I think we should watch is the rate of increase of rents is still positive, but it's starting to taper. Like DFW in January was 16% year over year increased rents, which is a huge number. And then June, it was 14%. Well, is that a trend or is that just a hiccup? Is that going to continue to drop where maybe there's no rental increase by the end of the year? How fast will that go down? The other thing, I'm starting to see it now, but 2 months ago, I did not see where other sponsors were increasing their expense ratio on the projects they were buying. And so they're looking at 2020 expenses with 2022 income. And it's like, let's be fair. Our expenses are going up. Inflation is hitting everything, materials, labor, the whole bit. So you got to make sure that you absolutely increase the expenses to cover the cost of inflation, because if you don't, your model is going to break and your investors won't be happy.
That's right. Yeah, and once you're and then you're talking about doing all the work and then putting somebody out of work after it's all done. That's the same thing with investors as far as investors go.
Hi, this is Casey Brown, host of the CashFlowPro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making CashFlowPro part of your day. Now, back to the show.
I mean, why raise all that money and why go into it only to have your model break at some point, like you said, and then have to kind of go to them. And not only that, now you've got to trudge through the mountains of saying, hey guys, this isn't going to do what we thought it was going to do, having them be pissed off at the end, and then you don't get any of them back.
Yeah, no, that's for sure.
It was all somewhat done knowingly in the beginning. And so it's a tough world right now. I mean, everything, we're kind of balancing between, hey, this is a decent deal and stay away from it. But the thing is that just about everywhere in the world, there's a housing crisis right now. Well, everywhere in America, there's a housing crisis right now. It seems like a lot of I know our tertiary markets, which I had before everything kind of got to where it is now, the word tertiary, I don't know that I'd ever used it one time in my entire life. And now it's all I hear.
That's right.
because everything is a tertiary market. Like, for instance, where we are just outside of Nashville, or, if you go just outside of Houston, or you go just outside of Austin or Dallas or wherever, and, then you kind of move on from there. But so what, you've got the project in Albuquerque, you said, right? You and your son are doing it.
Yep.
Where was the hotel conversion located at?
The conversion there is in Sierra Vista. It's down near the Mexican border, southern Arizona. It's a heavy military town, and there's a ton of contractors down there that support the military, and it's a intelligence base. So that base doesn't have boom and bust based on the military deployments. It's always been active because that's where the drones. They fly more drones out of there than I think anywhere. It's an intelligence Army intelligence base, Fort Huachuca. And so that's a big supplier, but there's other things in there. Tourism's there. It's at 5,000 elevation, so the weather is milder than Phoenix. It's a retirement community, so yeah, it's a great area right now. It's small. It's only like 40 or 50,000 people there, so it's pretty small. I don't recommend people going to that small of a market unless you really know it. Like, it's in our backyard, so we know it. But I wouldn't find a 50,000 population place in Texas and say, okay, this is a good deal, unless I did a lot of homework first. So. But we're looking heavily in.
When you say a lot of homework, I mean, yeah, you're right, because some of those things, man, you can get drowned out pretty quick in one of those smaller markets like that. I mean, because the thing is too, not only are you stepping into something that maybe a lot of people coming from the outside looking in may not understand that market, for one, but number two, you also have a lot of. I've tended to find that in every small market, there's a couple really big fish, and if you get in on one of those markets, on one of those big fish, and those big fish will whop that tail, and suddenly you're not in that market anymore, or you're in that market and you wish you weren't in that market.
Yeah, the other thing you see is we had flipped some houses back in early 2000, 2004 and 5 up in these mining towns in the east of the Phoenix metro. And then we sold our last house there, and I went to buy some more, and my brother says, I don't think we should buy any more houses there. I said, why is that? He said, well, it's a one-horse town, and the horse left. And that was mining shut down out there, and the market just died, so we didn't buy any more out there. We were able to do well on the few houses we flipped out there. We fixed and sold, but yeah, that was pretty funny when he said that. Yeah, it's a one-horse town, and the horse left. So you got to be cautious.
That's right, the horse left. That's right. Well, all right. Well, listen, Bruce, I've got a couple of questions we ask every guest that comes on the show. And the first of those is, what is the best book that you are currently reading? I'm sorry. What is the best book that you have either recently read or are currently reading?
The best book that I read, my favorite as far as personal development, was Relentless by Tim S. Grover, the personal trainer for Michael Jordan. That was an
Yep.
incredible book. I've read it numerous times, listened to the audio. It's a great book for flipping the mindset.
Yeah. I'll
But
tell you.
but as far as business, the best book is The Secret Life of Real Estate and Banking by Philip Anderson. It's a textbook read. It's amazing.
Gotcha. All right. Good deal. What is a dream vacation that you have either taken or hope to take?
My dream vacation was to Kangaroo Island in Australia. My wife's cousin lives there, and we went there, and we want to go back. And it's incredible to be on this island of 4,000 people in southern Australia.
Man, I'm sure. I tell you, Australia is definitely pretty high on my bucket list in general. I say that, man. Every time I ask that question, I'm like, oh yeah, I can't wait. That's what and it's just like I'm like all these things I want to do, not enough money, hopefully enough time, but definitely not enough money. So, but all right. Well, listen, Bruce. If the listeners heard something that resonated with them, or something that they want to learn more about your company, or about yourself, or about your all's investment thesis, or anything that they want to learn about you, what is the best way for them to get in touch with you?
Go to Bakerson.com. That's Bakerson, Bakerson.com. And you can click and get right on my calendar right through the website.
Awesome. Awesome. Bruce, thank you so much for taking the time to be with us today. We really appreciate it. And we really appreciate everything you brought to the episode so that, again, those conversions, man, that's so big. I think the hotel conversion business is something that really came, and I think it might be leaving now simply because COVID is kind of we're kind of hopefully, God, we're on the tail end of COVID at this point as this episode's being recorded in July. But listen, listeners, as always, please, please, please head down and leave us a 5-star review, and also type a review so that other listeners may know what we talk about here on the CashFlow Pro. And again, Bruce, thank you for being with us. Oh, the most important part about that, hit that subscribe button. Hit that subscribe button, smash that subscribe button so that you can be notified when new episodes come out, and everything will be dandy. Bruce, thank you so much, and I hope everybody has a wonderful rest of the day.
CashFlow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.